In an uptrend, you want to buy pullbacks, but how deep is too deep? Fibonacci retracements give you a map, a set of levels where pullbacks tend to find support before the trend resumes. Used alone, they're noise, but used with confluence, they become one of the best pullback timing tools there is. Let me show you the levels that matter and the one zone the pros watch. You draw fibs from a swing low to a swing high, and the tool plots horizontal levels at key ratios: 23.6, 38.2, 50, 61.8, and 78.6% of that move. These are the depths a healthy pullback commonly retraces to before continuing. A shallow pullback to the 38 is a strong trend. A deep one to the 78 is on the edge of failing. The meat of the action is the 38 to 61.8 zone. The single most watched level is the 61.8% retracement, often called the golden pocket. It's the sweet spot, deep enough that you're buying a real discount and shaking out weak hands, but shallow enough that the larger trend is still intact. A pullback that holds the golden pocket and turns back up is a classic lower risk continuation entry. Buy there with your stop just below the 78.6, and you're risking a little to rejoin a lot. Now the hard truth, because this is where fib traders go wrong. A Fibonacci level by itself is just a line on a chart. Price blows through lonely fib levels constantly. What gives a fib level power is confluence, when the golden pocket lines up with a prior support level, a rising moving average, or the anchored VW app, all at the same price. One fib level is a guess. A fib level stacked with other evidence is a high probability zone. Never trade a fib in isolation. On a real chart, the fibs you trade are the ones that overlap something real. Find a clean swing, drop your retracement, and look for the golden pocket to land near a horizontal support level the stock already respected. When price pulls into that overlap and shows a reversal, you've got Fibonacci and structure agreeing on the same price, and that agreement, not the ratio by itself, is the edge. Place it correctly. Fibonacci is a tool that sharpens the key level signal. It refines where a pullback is likely to turn. It doesn't replace structure, momentum, or a trigger. It makes your entry more precise once those are in your favor. Use fibs to fine-tune the location of a trade the rest of your stack already justifies. So draw fibs across a clean swing, watch the 38 to 61.8 zone, treat the golden pocket as your prime pullback entry, but only when it overlaps real support or another signal. Confluence turns a line into an edge. Subscribe for the full method and trade your own plan. This is education, not financial advice.